Hi there. My name is Victor Louis, and I'm the head of investment advisory at Sankore Global Investments. And this is your weekly financial market update. We start off in the US markets, where stocks closed lower on Friday as a stronger than expected jobs reports essentially dampened market expectations for further rate hikes by the US Fed this year. The Dow lost 1.63%, the S&P was down 1.54%, while the Nasdaq shed 1.63%. As the major indices drifted into losses for 2025. The U.S. economy added 256,000 jobs, significantly higher than the 155,000 that the market had expected, also with unemployment rate dropping to 4.1%. Now, for the week, the Dow and the S&P both lost 1.9%, while the Nasdaq was down 2.3%, as all indices essentially notched their second consecutive losing week. We also saw the yield on the 10-year U.S. Treasury spike, in the aftermath of the jobs reports. Again, this just continues to create a pressure point, for equities. The market is now pricing in a 97% chance that, the Fed will hold rates at its, meeting later this month. Also, the odds for a rate cut at the March meeting has fallen to 25%. This odd was sitting around 41% just about a week ago or so. Again, this just highlights the the sentiment of the market, really, particularly with the strong job number and the impact that the market perceives it will have on inflation, and obviously what that would do to the path of the Fed in terms of rate cuts going into this year. Also, we saw the University of Michigan Consumer Index on Friday, which essentially signaled some concerns on the inflation front. We've seen one-year inflation expectation go from 2.8 to 3.3%. We've also seen the 5-year inflation expectation go to its highest level, since 2008. Also, if you look at the historic spread between Fed funds rate and the U.S. 10-year Treasury, that has narrowed very, very significantly, and also remains a major pressure point, for equities as well. So right now, it really is the story around the strength of the economy, and the fact that that strength doesn't allow or doesn't really create room for the Fed to carry on aggressive cuts, which obviously should be helpful for equities going into the remainder of the year, and that remains the dampener, if you will, for the market. For this week, really, attention will be focused on Q4 earnings. Some banks are slated to release, some of their results. Wednesday and Thursday, you have Bank of America. You have JP Morgan and co. They'll be putting out their results. Also, we have CPI data, which should be coming out on Wednesday. That data point will prove, again, really, really crucial, particularly in this situation where inflation concerns have become sort of front and center. It'll be good to get a sense of how that, metric really and truly is, performing. Over in Europe, Eurozone inflation rose for a third straight month, came in at 2.4% in December, which was largely in line, with expectation. Again, in spite of the fact that, we're seeing inflation rise, the ECB is actually expected to continue to trim rates this year. The expectation is that it will take rates from about 3%, where it is now, to 2% this year across several trims, this year. Inflation in Germany came in at about 2.8%, while inflation in France was 1.8%. Q3 GDP growth for the Eurozone came in at 0.4%. For the Eurozone, still a number of challenges and headwinds that need to be dealt with. This year in particular, we've got some political instability, the sort of manufacturing weakness that we're beginning to see, and obviously the potential for trade tensions with a Trump presidency. These are formidable headwinds that the Eurozone is going to have to navigate in 2025. Over in China, trade data came in much better than expected, really. And this is on the back of the fact that we're seeing exports grow very significantly. And this is can be basically, chalked down to the fact that we're seeing exporters essentially front load shipments in anticipation of, tariffs from the Trump administration. So we've seen a very significant jump, in exports. So in December, for instance, exports jumped 10.7% in dollar terms from a year ago. Again, the expectation was for an increase of about 7.3%. And this compares very strongly to the 6.7% increase that we saw in November. Over the Nigerian markets last week, sentiment in the treasury market was largely influenced by the auctions that we had. There was a primary market auction, and there was market operation as well. In the aftermath of the the primary market auction, we saw very strong demand, particularly for the 1 year paper, in spite of the reduction that we saw in that stop rates. Essentially, a lot of the net bids basically filtered through into the secondary markets. Now, the auction was, heavily oversubscribed. The DMO offered about 515 billion. The auction was oversubscribed by about a trillion. Stop rates remained the same, like I highlighted, across the 90 and the 181 day paper, but on the 1 year paper, stop rates declined by about 31 basis points. We also had a normal auction in the course of the week as well, also very heavily oversubscribed. The CBN ended up selling about 500 billion, which was what it offered, and it was pretty much the same thing at the primary market auction as well. Activity in the bond market was largely subdued. Sentiment sort of remained weak. The market really is expecting and anticipating that auction calendar to sort of get a sense of where things are headed, how much the government is looking to borrow, and all of that. So the release of that calendar really would prove crucial in directing market sentiment, at least in the near term. So that's pretty much our updates. On the global perspective, we'll be looking out for CPI data coming out from the US. Also, be keeping an eye on earnings that will give us a sense of the strength and resilience of the US economy. While on the local front, really, market is really just looking out for that auction calendar. That's pretty much it for our outlook and update for financial markets this week. Do have a very lovely and productive week. Thank you very much for your time.